Morella Fernandez. Welcome to Market Call on this Monday. Teal Linde is on the show today. He's manager at Linde Equity Fund, and we'll take your questions today on North American mid and large cap stocks. Here's how to reach us. 1-855-326-6266 is the number if you want to dial in. You can also send us an email, marketcall@bnnbloomberg.ca if you'd like to do that. Teal, thanks for coming in today.
Thanks for having me.
The market seemed to be starting off a little bit quieter on this Monday morning, which is a good thing. OECD also came out with its forecasting reduced growth, of course, for North America and generally in other parts of the world as well. But they're looking at it in a certain way where they're sort of projecting in a certain number of tariffs in certain places. Mm-hmm. Given that all of that's a little bit up in the air, we don't know 25, 10% on what's your outlook for growth?
Well, I mean, that's part of the problem is that there's so many things are up in the air. And so it's pretty unusual. We have in a situation where the stock market, business sentiment, consumer sentiment are all being heavily swayed by one individual south of the border. And it doesn't look like it's going to change anytime soon. So in terms of outlook, I thought, well, maybe considering the amount of sway, maybe we should, maybe there's some merit to sort of learn about how President Trump thinks and operates. And so he's co-authored 10 books. And so there's been research done on those books. And so I thought, well, let's dig in there and see if we can learn anything from that. And so I did.
What did you learn?
I did. It was actually really interesting. And so I actually thought I brought two quotes to share with you that might be of interest in your viewers. And the first one sort of confirms what we all kind of know, is that in his negotiations, he likes to anchor high. And that means basically making the first move with a maximalist demand.
Yeah, big, bold.
Yeah, big, bold. Seek the most value out of the negotiation as possible. And he does that so if he does have to compromise, and he says he rarely does have to, but if he does have to, then he can consider himself having a win. And so in his first book, The Art of the Deal, he talks about this, and he gave an example where he decided he wanted to get a tax rate from the New York City municipal government. And so he says in his book, quote, "I went in and asked for the world, for an unprecedented tax abatement on the assumption that even if I got cut back, the break might still be sufficient." Right? So it's really part of his playbook.
Okay. So go ahead.
And then there's a second one that's a bit more interesting, which sort of ties in with all the uncertainty. And you got with all the on and off again tariffs, stop and go, the constant moving of the goalposts, people wondering what's he thinking, what's he really want, right? And for most of his career, he's loved keeping people guessing. All right.
He loves the chaos, is what it seems.
Well, it appears that way, but he actually wants people to be guessing. And he actually, 14 years ago in another book, he says, quote, "Never let anyone know exactly where you're coming from. Knowledge is power. So keep as much of it to yourself as possible." Mm-hmm. So that explains all the uncertainty today. And so
one of the things we can talk about at the course of the show is how do you deal with that? Meaning if you're on the opposite side and you know how he operates, how can you use that to your advantage? Because that is something both Canada and Mexico right now are trying to figure out.
Well, I think he's pretty serious on the trade sort of revamping the whole international trade, because as a politician or as a president, you have many issues that you sort of address, and a lot of them times just lip service or just you have to address. But he's been talking about or being critical of international trade for over 40 years,
sure,
since the 1980s. So when he says that, when he says that America is like a chicken being plucked by the whole world, I think he actually feels that way.
Yeah, I'm sure he feels that way. I think for the first time, though, he's not running a business, and there are other factors at play, so that he's going to have to look at it. We'll talk about this in a moment. We do have to take a quick break. Teal sticking around to take your questions today on mid and large caps. Here again is how to reach us. We're back in a moment. Welcome back, and thanks again for joining us here on Market Call. We want to go right to your emails. Ash has written in from Stratford, Ontario, and says, would now be a good time to buy Nike? Just taking a look at Nike. Right now, it is down over the year, kind of quite a bit, down to 73.02 at this point, up today, but down generally speaking. What has been happening at Nike?
They've had a big fumble, and I don't know if they're going to be able to fully recover from it.
Okay.
And it really was a marketing strategy that they implemented a number of years ago. Because Nike's been around for 50, 60 years, and so they've always sold through other stores, third-party stores. And they started making their own stores a while back. I can't remember when, but it was about several years ago. They started doing direct-to-consumer sales.
Okay.
And a new CEO came in right before COVID, and he was really gung-ho on that. So they really leaned into the direct-to-consumer. And so what happened was that they started taking product off the shelf of their stores like Foot Locker and others, and it was causing friction. The stores had to now compete with Nike's online store. And the new CEO thought, let's do this because why? Let's remove the middleman. We'll get more margin, more profit, and be great for the stock. And it started off that way. It did. The stock did go up in 2020, 21. But the problem with that is that once they started taking product off the shelf, because they've always dominated the shelves. They were always the number one seller in every category. So retailers did not want to allow for others to have space there. But when Nike decided to take product off the shelf, it allowed other competitors to come in there. So New Balance was always sort of in the stores a bit. They jumped at that opportunity. And then you had Hoka and On Running coming in there.
So they all took over that prime space.
That prime space, exactly, which Nike used to own, but they gave it up to go to direct to consumer. And now these new competitors are in there, and they're succeeding. They're taking market share away from Nike, and I don't think they're going to be able to reverse it.
Okay. So right now you wouldn't buy into it, even though it's dropped as much as it has dropped.
No, they've lost that lead, and they've let the competition in the door, and that competition's not going away. It's actually they continue to gain.
Got it. Okay, let's go to the phone calls because we have a caller on the line. John has reached us from London. Hi, John.
Hi, Marilla. Hello, Teal. The Hudson Bay Company, longest-lived retail merchant, applied for bankruptcy. Is this a chance now for a couple of your favorites, Aritzia or, say, Dollarama, to go in and take some of that retail space and bring that Aritzia stock back up to $70? Thanks.
So those are huge retail spaces, though, right?
That's exactly what I thought. That's exactly what I thought. So, I mean, Aritzia, their biggest store, I think, right now is in Chicago at about 46,000 square feet.
Okay, good size, but
it's huge. Actually, like the store in Robson Street is about 13,000 square feet, so it's like 3 times the size. But the department stores are still much more larger than that. So I don't think it's going to open up space, and I don't know what's going to replace those large retail facilities.
Okay, so what would be in Canada's retail sector? Like there's Simons, which seems to have been growing over the past couple of years. Are they an opportunity? I know IKEA has gone into a spot that used to be a Sears, for example. Do you see any of those things happening?
I mean, remember the Eaton store?
Yes, I do.
So Eaton's used to be around and be very successful.
And then it was Nordstrom?
Yeah, Nordstrom's took over the spaces, and then, or at least in Vancouver, and eventually it never really made much money, and so they've receded from there. And so I suspect a lot of it could end up being more residential development in the end.
Got it.
Probably.
Okay. Let's go back to the phone lines. And Mike's on the line, also calling from Toronto today. Mike, what's your question?
Trying to ask about Ensign Energy Services. I know you've liked it in the past. Looks like the energy services companies, pipelines, et cetera, are struggling a bit, even more than the energy producers. Can you explain why?
Okay, great question.
Yeah, no, it's investing in Ensign is like a game of snakes and ladders, except there are no ladders. You just suddenly have these big, sharp drop downs. And precision drilling had the same thing. And I know there's a lot of fear and uncertainty in the market. A lot of stocks across the board have been dragged down that even have no direct relationship or exposure to tariffs, like a lot of tech companies. And I think that's the same thing's happened here. I mean, when they started announcing the tariffs on the oil and gas, there was already some weakness there, and it's just compounded a bit further. And it's a bit unusual because in January, Baker Hughes, they had a report that said that drilling activity in the Western Canadian Sedimentary Basin has been the strongest since 2015.
Okay.
Right, and precision drilling has about 2/3 of their operations in Canada, and yet their stock has come off sharply too. So I actually think they're oversold.
Okay, so and they're just getting brought down, you said, by generally what's going on in the market. Do you think they'll bump back up once we get a little bit more tariff certainty, if we are going to get that?
I believe so. I mean, the activity in Canada is quite healthy, and in the U.S., at least the natural gas price in the U.S. is a lot stronger than people anticipated because they've had the coldest winter in 6 years. And then the valuation of these companies, I think there'll be reversion backward uppers, particularly for Ensign, because Ensign is in a 3-year program to pay down $600 million worth of debt. And so that's $200 million a year. And so they just announced their fourth quarter results, and they said they've already paid down $437 million. So they're actually ahead of plan. So to get to 600 pay down by the end of this year. And once they achieve that, I mean, what should happen is that the value of the debt holders should transfer over to the equity holders. Okay. We haven't seen that yet. I mean, Ensign's share price is still back to where it was right before COVID, when oil prices were at $50.
Okay. Okay, so Ensign want to keep a watch on. We want to get to one more phone call before we have to take a break. And that is Jim, who's calling us from Elliott Lake. Hi, Jim. What's your question?
Hi, good afternoon. I just want to ask you about National Bank. Putting aside the drop in, well, all stocks, it seems, over the last few weeks here, you look at its longer-term numbers, 6, 12 months here, also been down. Just wondering, do you own it? Would this be a good time to get in?
All right, Jim, thanks for your call. We do own National Bank. We've owned it with clients I've had for 20 years, we've owned it for ever since then.
Okay.
And what I've noticed over the years, it used to always trade at a discount to the big five. And over the last year and a half or so, it started trading in line and above the average. And so the question was, is this a reset that's going to stay higher? Or is it just an anomaly where it's going to be short-lived and it's going to come back down?
Yes.
And so National Bank stock and valuation has come back down. So I think it's probably a reversion back to its historic mean. So it's not like, wow, National Bank's pulled back, let's jump in. I think it's pulled back to trade in a range where it's historically traded. It's still higher than where it's historically traded long term. So we continue to own it, but we wouldn't be picking away any shares today.
Got it. Okay. Teal Linde is joining us at the desk. He's manager and Linde Equity Fund of Linde Equity Fund. He's going to take your questions today. North American mid and large cap stocks. Here's how to hold us both by phone and by email. We're back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back to Market Call. We're going right to your phone calls. Terry's on the line, and he's calling us today from Edmonton, Alberta. Terry, what is your question today for Teal?
Today, my question is on Pembina pipelines. Do you like the pipeline space, and how do you feel about it, let's say, over 20 years with this renewable energy and Cameco and all these companies coming in? Thank you very much.
We've had a lot of questions about Pembina.
Yes, thanks for your call, Terry. Yeah, Pembina, it was actually a top pick last month that recommended, and I still like it today. I mean, it's moved up a bit.
It has.
But Pembina is the pipeline sector, of course, is resilient, and natural gas demand is expected to increase in North America over the next 10 years by about 40 billion cubic feet.
Okay.
And just for perspective, the United States consumes about 90 billion cubic feet per day of natural gas.
Okay.
So 40 billion cubic feet of increased demand coming from switching from coal to gas, increasing exports of LNG, data centers, and onshoring. So there's a lot of growth there. And Pembina is well situated. They've got the largest infrastructure in the natural gas-rich Montney region.
Okay.
And so they're well positioned to take advantage of the increasing exports of LNG off the BC West Coast. They're very well diversified. They got a pipeline full of projects that they can self-fund without having to issue any equity, even after paying a decent dividend. And their balance sheet is healthier than TC Energy and Enbridge. So there's a lot of things like. They even have a joint venture with an LNG export terminal, and they recently signed up a joint venture with a company that's going to build a data center on their lands, which of course they're going to supply the energy for.
So do you think the drawing down of the stock at the start of the year was just the generally tariff, everything coming down at that time?
Actually, I wasn't at the beginning of the year. I wasn't sure why it had pulled back, but it pulled back to the point where I thought, let's make it a top pick a month ago.
Okay.
And considering the strong fundamentals and his valuation coming down to sort of with the Spear Group, I thought it made it attractive. So I didn't understand why it came off, but I thought it looks oversold. Let's recommend it as a top pick and
go from there.
Yeah.
Okay, let's go back to the phone. Bradley's on the line from Toronto with a question. Bradley, what is your question today?
Question for Teal is, what do you think about Amazon? I plan to hold this for 5 years, and do you think, I'm just looking for 10% per year. If they could do that, I'd be happy. What do you think? Thank you.
Thanks for your call, Bradley. 10% per year ought to be doable. I mean, they're growing their revenues at over about a 10%, 9 to 10% clip, but they're growing their earnings even faster than that because a couple of years ago, they decided to relax on the constant continuous investment and not worrying about profits to let's start harvesting our investment, our assets. And so their earnings are growing at a double-digit clip. What's interesting, though, is Amazon now has pulled back, and the valuation of Amazon today is similar to Walmart.
Interesting, because they were at 242 at one point, I guess, in February. They've dropped down to 194 at this point.
Yeah, and so the PE ratio is on a forward basis around 31, 32 in the area, and so is Walmart. I mean, Walmart stock has gone up so much that it's trading around 30 times earnings. So you got to ask yourself, what would you rather buy? I mean, Amazon's growing at 10% on the top line, and Walmart's growing around 4%. And I would suggest that Walmart's probably overpriced and Amazon's more fair.
Do you factor in the sentiment at all? There's a lot of sort of anti-American sentiment. Consumers are choosing to buy Canadian, that whole thread?
That would be, well, the tech stocks across the board have all sold off. So I don't know if there was anti-American because Amazon is so large in the U.S. and in other countries that I don't think Canada alone could impact the stock price that much.
Okay. So it's not something you would factor in heavily. Okay, let's go back to the phones. David's on the line. He's calling us from Ottawa with his question. Hi, David.
Hey, good afternoon. Thank you for taking my call. My question is on Bank of Montreal. I noticed that even with the Royal Bank, a lot of the banks have gone down about 5% in the past few weeks. Is there a reason for that, despite the very positive earnings with most of the Canadian banks? Do you own Bank of Montreal? And if you don't, do you think it's a good time to buy? Thanks.
Okay, thanks for your call, David. I'll just answer the last question. So we do not own BMO. And it's not a stock that we'd be buying today. Bank of Montreal, because it has the largest sort of proportional exposure to commercial banking, it's the most volatile of the big five.
Okay.
Commercial banking is, right, you end up being more volatile stock. So when there's a recession or there's recession concerns, often BMO stock gets, and historically has been hit the hardest. So it's been a great stock to trade. And even if you go back to last year, it was sort of come down quite a bit compared to the others, and it shot up a lot because of the improvement sentiment out there. But now that there's talk about a possible recession with all these tariffs, and we know that BMO is more vulnerable, well, not as the bank, but the stock, right? And is more vulnerable to having a downside swing, we wouldn't be buying it today.
Okay. Let's move to our next caller, Ghulam, calling from Toronto. Hi, Ghulam.
Hi there. Good afternoon. My question is on Bank of Nova Scotia. I have some, and I'm losing about $10 on it. I was thinking of buying some more and, dollar cost averaging. You think it's a good idea?
Lower cost averaging, he's lost, I guess, $10 is what he's saying?
Then he must have bought it, looking at the chart, must have bought it, close
last
to $80.
Summer? What are we at now?
So,
$6.69, and back then we're at, well, yeah, he might have bought it on the upward slide.
Yeah, around, perhaps, yeah, near $80. And so, well, again, this is a bank that, and I can say for all the banks, they really shot up in the fourth quarter. And if I look at where they historically traded in valuations, it was at the top of their range. And I was actually surprised that Bank of Nova Scotia shot up as much as it did, because it's a bank that's sort of in transition. It's had a lot of difficulty in recent years. And so for the stock to rally, I thought, well, they really haven't turned things around. And so, for the stock to come back down to where it is now, I think is probably more suitable considering where the company is in its turnaround.
Does that mean you think he needs to just settle into the loss that he has?
Well, it pays an attractive dividend. I think it pays about like 6% dividend. So you can hang on to that. And Canadian banks have a history of always coming back.
Okay.
Over their 100+ years.
It's just a matter of timing.
It's just a matter of timing. I mean, you could trade the banks. I mean, you can almost like leapfrog. You buy the bank that's underperformed the most and buy that, and then eventually it'll recover, and you'll make the dividend and the capital appreciation and recovery, and you just keep doing that with the banks if you're into trading.
Yeah, which means you just got to keep your eye.
Yeah, and with BMO being probably the most lucrative bank to trade.
Got it. Okay, we do have to take a quick break. Teal is sticking around to take your questions as well, but when we come back, his past picks. Back in a moment. Welcome back. Thanks for sharing some of your time with us today. We have Teal Linde in house, and right now we're going to take a look at his past picks, almost a year to the day. March 18th of 2024, he first picked Brookfield Corporation on the TSX. At the time, it was 55.51. At this point, it's up to 72.82. So a 31% return, total return of 32%. So it's done very well. What has Brookfield been up to in the last year?
Well, I think the most important thing for long-term investors in the last year was their investor day back in September, where they expect to grow their distributor earnings by a 17%, well, not expect, that's a 17% compound annual growth rate over the next 5 years.
Okay.
And their target is for their a 25% compound annual growth rate when they can include the ramp up of the realized carried interest that they anticipate.
So that's when things started to go, well, on quite a nice lineup.
Yeah, I mean, because that's for a $100 billion plus company talking about growth rates of 17 to 25%. I mean, that's quite phenomenal. And if you haven't owned if you never had a chance to buy the stock, it has pulled back lately, and because of all the tariff concerns. And then KKR was the industry leader. They announced results which the market didn't quite like, and so they may have also sort of dragged down the sector a bit. But with all this tariff talk, Brookfield really doesn't have much exposure to that because they like to invest. They've identified countries. They invest in backbone infrastructure, and they have products and services which basically sell to the domestic economies. They're not really into cross-border trade. Yeah,
they seem to have bucked the trend where everybody else was falling in January and February. They've actually been still going up, so they seem to be doing well. But if they drop down a little bit, it might be a good time to get in.
Yeah, we find it attractive at this level.
Okay, let's go to your next pick from last year, which was Blue Owl Capital on the New York Stock Exchange. At the time, recommended $17.43 American. Now it's up to $19.64, so 13% return, 17% total return. What is Blue Owl Capital? Tell us about it.
Well, Blue Owl Capital is another alternative investment manager, similar to Brookfield, except they focus on private credit and then commercial real estate, where they get involved with the sale leaseback opportunities where investment grade companies want to monetize their real estate. Okay. They will assist in that. And then the third big business is they're basically bringing alternative investing to retail investors. All right.
Okay.
And they also had an investor day in February where they're targeting a 20% annualized growth rate of their fee-related earnings, which again is quite phenomenal. And with the stock now back down to where it is today, you can get that kind of growth profile paying about 20 times earnings.
Okay, so let me ask you a little bit about that, because you mentioned they made that announcement in February. We see things trending down for them at that point. Was that because of markets in general, or did investors not like what they had to say? What happened there in the February aftermath?
Well, actually, right before they had their investor day, the day before they announced their fourth quarter results. And that's when they talked about their expectations for this year, and they expect their fee-related earnings to grow 25% this year. So even better than the 5-year forecast of 20% per year. So they had great results. But I mean, if you look across the board, I mean, a lot of stocks and a lot of sectors have sold off, and so they got caught in that. But again, KKR being the industry leader came up with results, and they got hammered a lot more than their peers. But I think because they're the industry leader, I think it impacted sentiment. And some of their other peers had mixed results. So Blue Owl had probably some of the strongest results in the peer group. But sometimes when the whole sector gets dragged down, you get dragged down with it.
Yeah, you're going with it. All right, let's get to your last pick from March 18th, 2024. TC Energy, at the time, 54.52, and now at 68.13. A return of 37%, adding in your dividend, 46% return, which is phenomenal. What's been going on over the last year for TC Energy?
Well, they've got they were oversold for a while, so sometimes it had a low base to help get that 46% return because it's not a fast-growing company. And then, of course, of all the excitement around the data centers and how they're going to be powered, that sort of helped the whole natural gas story. And then I think, and then more recently, what's interesting is that pipelines are always great. They're one of the most defensive sectors when there's a downturn, economic downturn or recession. And they've really delivered on that front because since February 19, the S&P 500 has entered into a correction. I mean, it's up a little bit now. And yet TC Energy since February 19 is up 4%. So that's why you want to own. Yeah, that's why you want to own some pipelines, because if the market was to go down a lot further, then we would look. We own some TC Energy. We would look at it as a source of cash to take advantage of stocks that are going to really beaten up.
Got it. Okay, Teal is sticking around to take your questions. When we come back, stay tuned. Welcome back to Market Call. We are going right to one of your questions from an email. Donna wrote in to ask about Gilead Sciences. She says, can I have your opinion on Gilead Sciences, please? Very short and sweet. Donna from Barrie, Ontario. Gilead, tell us about Gilead.
Well, Gilead's actually a stock we used to own about 10 years ago.
Okay.
And back then they had the hepatitis C drug, Sovaldi and Harvoni.
Okay.
And it was actually a cure. And so there was all this, and they were going to charge $80,000 per regimen. And so there was a lot of excitement on that because it was an actual cure, and the company talked about how it was a vast opportunity to cure a lot of patients. But I was always wondering, well, what happens once you cure all the patients? What's going to happen to your cells?
$80,000 is a huge amount of money, no?
It was huge, and there was all kinds of ethical debates about how can they charge this kind of money. But then when they sold the drug to other parts of the world, it was like in India, for example, it was like $1,000. But Americans had to pay $80,000. And so you see the writing on the wall. Well, what's going to happen once you've cured? Once everyone that can afford to buy the drug has bought it and they've cured. And so we didn't hang on to it that long. And that's what happened. The stock shot up and then eventually came down. We're looking 10 years ago. But as they cured all the possible patients. But they made a ton of money through that. And so they took those profits and they started investing it mostly into their HIV franchise. And that's sort of where they've been focused ever since.
Have they had any success?
They have, and I think the stock's actually run up recently. But they have patent expiries on these HIV drugs, which happened probably in several years. And I'd be careful of buying any kind of drug company where you have a patent cliff
It's
several
a
years
limited
from now.
upside, I guess.
Yeah, so what happened, because we had that experience with another company called Celgene. Celgene had a blockbuster drug, and they also had a patent cliff 7-8 years. And I thought, well, 7-8 years is a long time from now, but the time goes by faster than you expect, and soon the patent cliff starts discounting into the share price, and you're either going sideways or down. So we kind of stay away from pharmaceutical companies that have these big blockbuster drugs that have expiry dates down the road.
Got it. Okay, let's go back to the phone lines. John's on the line from Milford, Ontario. Hi, John. What's your question today?
Good day. I would like Teal's thought on TD Bank. However, I have a strategy. I've owned all the banks for about 20 years, and I'm up really huge on them. National Bank, I paid $39. I would like your thoughts going forward. I'm thinking of with what's going on in the world, selling them, putting them into cash, and buying them back later with the way things are going with Trump. What's your thoughts on this? Thank you very much. Bye.
Okay, so let's talk about TD, of course, in a different situation from some of the other banks. They had to limit what they could buy in the U.S. They got slapped with a big penalty down there. So some are saying it's a good time to buy because their stock's actually at a lower price. What do you think?
It is. I mean, I thought it was attractive when it was in the 70s, and now it's jumped up. And I think the upside is probably going to be pretty gradual from here because they are in that transition. I think they pulled some of their guidance, and the earnings expectation growth this year is pretty flat. But as it gets closer to the fiscal year end of October, and the market investors start looking at next year, I think you could probably start to see some lift there.
Okay, so it'll be another year before you start seeing it
Yes, because it's already had a pretty decent jump from where it was last fall when it was in the upper 70s. And considering that there's not much earnings growth, that's a pretty good move. Now, what they're doing, you mentioned about their asset cap in the United States. I think they got capped. They cannot grow their assets with their U.S. retail banking. And so what they're doing is they're just sort of upgrading what they have and just sort of cleaning out and taking out what might be a higher cost of funding or lower yielding and then reinvesting into higher yield. And so basically improving the quality of that portfolio. So actually it's an opportunity from their sort of a cleansing.
Yeah, getting things to move a little bit better. Okay, let's go back to the phone lines. We have Nazar on the line who's calling from Scarborough today. Nazar, what's your question for Teal?
Oh, hi, Mel. Hi, Teal. May I have your thoughts on Sun Life Financial, please? It reached a high of $88 and is now trading at around $80. Do you see it go back to high 80s? And are life cos a better buy than banks in these uncertain times? And do you own Sun Life Financial? Thanks for taking my call.
Thanks very much. And let's start with Sun Life. First of all, do you guys own it?
We don't.
Okay.
So there were three questions there. We don't own it. Another question was, we asked if we owned it or not. We don't. And then another question, will it get back to $88 in time? It most certainly will over time.
Okay.
And then the other question was interesting. Is it better are you better off owning or life insurance companies instead of banks right now? And I guess if you were to buy a bank or a life insurer and had to choose between the two, the life insurance companies have less exposure to the tariffs. Now you think, well, the banks don't do any cross-border trade. Why would they be impacted? But the banks are very vulnerable to rising unemployment. And so if these trade tariffs go in, particularly on the auto sector in Ontario and the steel and aluminum, and if there's a lot of job losses, then the banks are going to feel that. And of course, if there's a recession in either country, the banks will feel that more than the life insurance companies. So it's interesting. Over the long haul, the banks have been better investments. But in the near term, life insurance have some more redeeming qualities today.
Okay, so you would leave it there if that's where it already is.
Yes.
Got it. Okay, we are going to take a quick break. Teal Linde sticking around, manager at Linde Equity Fund, to take your question today on North American mid and large cap stocks. Back in a moment. Welcome back, and thanks for joining us on Market Call. We want to go right to the phone lines. Sal has been holding on. He's calling from Toronto. Sal, what's your question today?
Hi, Teal. My question is on Adobe. Just looking at some of the metrics, it seems to be at like a blended PE of around 20.8. Like that seems really low for a company that right now has got a large cash position. Had its earnings seemed like it hit the mark, but the forecast undoubtedly was not so good, and it did take a hit. I just wanted to know, is this a good time to add to Adobe? Thank you.
How does Adobe stack up with others in that sort of creative professional range where they're trying to put AI in, but not necessarily getting there?
Well, it's the industry Goliath for sure in the creative space.
Sure, very well used by professionals across the space.
Yes, and so there's a couple of things that they're being criticized for. Is like, what are you going to do with a lot of these upstarts that are going to potentially take away your business? And then and then the others are like, well, why aren't you monetizing all these AI features more? Right? And so the caller said it's growing about 10% on the top line, 20 times earnings, dominant in its industry, de facto monopoly in certain cases. And why
Absolutely.
And so the valuation is quite attractive. I mean, that's like a market that's slightly below or in line with the overall market average for the S&P 500. And so I think one of the problems they have is they're not being able to communicate how they're monetizing their AI. For example, in their latest quarter result, they said they're generating $125 million on an annual run rate from AI product. And one of the analysts said, well, when's it going to call this, or when's that going to grow to a more meaningful amount? And so the company says, well, we have AI products that are embedded in some of our existing subscriptions, which is helping to increase the subscriptions. They're not getting a higher price, but because they throw it in there for free, it's actually improving their sales.
Okay.
They have subscriptions where they have some AI features included, and they can use that to justify increasing the price. So if they increase the price 5%, well, how much is it because of the AI and how much is what just sort of
They're not
natural
separating
inflation?
that out.
They can't separate it. And so the analysts, they focus on the 125 million and they, well, that's it. And so they have to find some better way to clarify, to communicate the progress they're making.
Got it. So really, it's more about communications than it is about them incorporating the AI and getting the customer to pay for it.
That's right. Another thing they got to do is they want to segment their customers. They want to get those who are prepared to pay more for the AI, and have easier onboarding for those who are don't have as deep pockets. And so they're trying to figure that out. And so these are all the things that they're working on for this year. And so we own a bit of Adobe, and so we continue to hold those shares.
Got it. Okay, let's go back to the phone lines. Ken's on the line, calling us from Trail in BC. Hi, Ken.
Hi.
Go ahead.
Yeah, I was wondering about something that, a company that builds military equipment in Canada, and I was thinking of maybe Bombardier.
Okay, so are you asking, is there another company you should invest in, or are you asking specifically because you want to invest in Bombardier?
No, maybe there's another company that would be as good or better.
Okay, let's turn that over to Teal. So Bombardier, a very well-known Canadian company. Are there others that he could look at that have some comparables?
In Canada, I'm not aware of any to suggest. Bombardier has a defense component, and there's an opportunity to grow that. That's part of their growth strategy, because right now they primarily do business jets. And so this is a company that is impacted by the tariffs, because they do a lot of their final assembly and their interior furnishings all done in Canada, and yet they estimate maybe half the components come from the United States, so there's a mix there. But in terms of business jets, the United States represents 2/3 of the global business jet market. And so if you're going to face tariffs going in there and you have to compete against domestic brands like Cessna or the Learjet line, that could be an issue.
Yeah, that it'd be pricey to bring them back into the U.S. under a tariff situation.
Yeah, but the defense, if Bombardier has more defense products, those will be, my understanding is that they will not be as exposed.
Got it. Okay, let's go get one more phone call here. Punkaj, I believe, is the caller calling from Brampton in Ontario. Hi, what's your question today?
Yes, ma'am. I would just like to know about two stocks. One is Tesla and one is Nvidia. So is it a good time to enter the market? And if you could suggest one or two good dividend-paying stocks also, it'll be, appreciated. Thank you so much for it, Mark.
Thank you. So Tesla's an interesting one, which we were talking a bit about at the break, because it's been hit a lot by just consumer sentiment and people not liking Elon Musk and what he's doing in Washington.
Yes, and then plus Tesla sales in other parts of the world are really good.
Slowing down.
Hit. I mean, I saw stats in Germany in the month of February, sales were down over 70%.
Wow, okay.
Yeah, Australia down over 70%.
Yeah.
And Germany, electric vehicle sales were up 30% overall.
Yeah.
In China as well.
It's lost more than half of its value since the start of the year.
Yeah.
Is it because there are other competitors that are out there that are making better products at this point?
Well, there is a reaction to Elon Musk. That's obviously in there with all the protests at the dealerships. I mean, there've been drive-by shootings of Tesla dealerships in the United States.
Yes.
Just a few days ago, someone took 12 shots.
So would you invest in it if it's dropped as much as it has? Like, is there a bounce back for this company?
No, I think, Tesla recently hit, an all-time high. And it's like some of those banks, I think National Bank, that just shot up. And Tesla, there's a lot of stocks that shot up in the latter part of last year. And so if you look at a 5-year chart of Tesla, you'll see that it's down considerably, but it's mostly just given back this huge gain that it had just in the latter part of last year. And so it's sort of back down to a sort of baseline if you look at the 5-year chart. But the thing is that last year, their auto sales were down 1%. And then Elon Musk in January he thought that 20 to 30% growth would be good. He actually said that in 2026, it would be an epic year, And 2027, he thinks that 2026 would be epic, 2027 ridiculous, and 2028 ridiculously good. Okay. And that's his forecast. I said, that's my prediction. And it's not turning out that way. I think I think with Tesla, he did come out and say that he's having great difficulty managing the business because he's spending so much time in Washington. And so the question is, well, how long is he going to spend his time sort of in Washington and not focused on his SpaceX and Tesla? And he said he expects to be involved with the DOGE committee for another year.
Wow. Okay. So not at the helm of the company. We do have to leave the conversation there right now. We are coming back with Linde's top picks. That's coming up in just a moment. Welcome back to Market Call. It is time now to check out top picks from our guest, Teal Linde. His first one is Air Canada on the TSX, of course. Air Canada has dropped quite a bit. Last time I checked this morning, it was down around, I think, 17, somewhere in that range.
It gone down even further from there.
15.28 is what we have it right now. So what's going on? Why would you recommend Air Canada at this point?
Well, I mean, along with their rebuilt balance sheet and valuation now that is sharply below its historical average, it's really an example of being able to follow the insiders. Because last fall, the airline industry in North America was doing very well, and the American U.S. airline stocks had really shot up. But Air Canada hadn't moved up as much, and so I think management saw that, and so they authorized a 12-month share buyback program, and they must have liked the share price back then because they used up 90% of their 12-month authorization in the first 3 months.
Wow. Okay.
And in the first 2 months, they were buying. Well, most of that was buying shares under $24.
And now they're down to 15.
That's right. But even before we got to 15, so the stock started going down with all the trade tensions. And then in the latter part of February, several insiders at the executive level started buying shares of Air Canada. And then on March 3, the board issued a boatload of stock options to management at a strike price of $17.03. And now the stock is close to $15. So if you were to buy the stock today, you're getting it at a lower price than the share buyback, than what the insiders paid for, and less than the exercise price of all these stock options that were issued. And so if Air Canada stock just went back to where it was 4 months ago, you'd be up over 50%.
Are you worried at all that a lot of North American flyers are saying we are seeing travel demand kind of lower at this point as people are worried about their jobs?
Yes, I mean, you've seen U.S. airline stocks have come down, and one of them says because we have less Canadians on our airlines. And so I was thinking to myself, well, is it because less Canadians are going to the United States, or are Canadians being more nationalistic and deciding to fly Air Canada instead of these American airlines? I don't know for sure. But the advantage that the airlines have is that if Canadians decide they don't want to travel to the United States, but they want to travel somewhere else, they can easily move their assets and their planes to service that demand going elsewhere. But I would agree with your point. I think travel is going to come off a bit, but I don't think it justifies the massive decline in the airline stocks we've seen in the last few weeks.
Got it. Okay, let's move to your next pick, which is an interesting one, Pinterest. What do you see happening in Pinterest? And I haven't checked in on Pinterest in a while.
Well, I guess, just a higher level, Pinterest is an attractive growth at a reasonable price stock. I mean, they're growing their revenues at about a 15% year-over-year rate, and it's trading less than 18 times this year's expected earnings. And typically when you find a company growing at a 15% rate, you got to pay like 30, 40 times earnings or more. And so, so what have they been doing? And so the catalyst is that new management came in the middle of 2022.
Okay.
And they've been making noticeable improvements to the platform. And they're leveraging to do that. They're taking advantage of the power of artificial intelligence and machine learning to increase the relevancy of the content that the users engage with.
Okay.
And it's so effective that they're able to actually serve up more ads, and because of the artificial intelligence, because of the
it's
tools,
able to tune in more.
They can tune in. They make it, even the ads are more relevant to the user. And so they have the combination of increasing usage and increasing advertising that the users don't seem to mind, and which is contributing to higher revenues.
Got it. Okay, I do want to get in your last pick because we are running low on time, and that is Alphabet, which of course is Google's search engine GOOG on the trades at 164.57 right now. What do you like forward thinking for Google?
Well, first of all, it's the valuation's attractive. It's the least expensive of the Mag 7 and around 18.5 times earnings. And if you look at Apple and Amazon and Microsoft, you're looking at 25 into the low 30s. And so it's also got what's weighing it down is some of this tariff, or not, sorry, the
whole tech slide.
There's the tech slide, but then also they got the they wanted the Department of Justice is threatening to wanting to break it up.
Yes, for sure.
And so they've honed in on the Chrome is the one that the Department of Justice is considering recommending to sell. And so these that's a factor. But if you look at what the U.S. administration is doing, they protected TikTok from being shut down.
And do you anticipate they might protect Google?
Well, so TikTok was the Department of Justice that we should shut it down. The Supreme Court said they should shut it down, and then President Trump put an executive order say, let's give them 75 more days.
20 seconds or less.
20 more seconds or less, and so there's opportunity to make a deal there. But then also on the search, people are worried about all this chatbots eating into their search business.
Yep.
And a lot of the search that goes in the chatbot and Perplexity is very knowledge-seeking. It's not. There's no commercial intent.
Got it. I have to leave it there because we're running out of time, but great to have you in. Thanks very much for joining us at the desk. That's it for Market Call today. Thanks very much for tuning in. We'll see you again tomorrow.